Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Global stocks head for their longest losing streak in more than 2 months as inflation fears grip investors. The bond sell-off sending long-end Treasury yields to their highest since 2007. Traders now await earnings from Nvidia. The Chinese president says a ceasefire in the Middle East is imperative as he welcomes Vladimir Putin to Beijing, just days after his summit with President Trump. Plus, backing down, the EU finally agrees on the wording of a trade deal with the US, taking out amendments that were criticised by the US president. Well, a very good morning. Welcome to the programme. 6 a.m. here in London. And take a look at the market impact of President Trump's threat to resume Iran strikes in a push to end the war. Yes, oil is a touch weaker, but Brent's still trading above that $110 a barrel level on Brent. That's stoking inflation concerns. And as I say, we've seen the Treasury yield on 30s climbing to levels last seen in 2007. That on bets that the Fed is going to have to hike before it can cut. Citi saying that 5.5% is the new round number bond traders are focused on. You also have the Bloomberg Dollar Spot Index edging higher at its highest in 6 weeks. The haven of choice, of course, throughout the Middle East conflict. So now just flat to the upside. And if we flip over to the equity picture, you can see that inflation angst weighing on stocks this morning. Asian stocks down 1.1%, down for a fourth straight day on the MSCI Asia Pacific Index. And Samsung shares dropping after its Labour union said it would go on strike. That weighing in particular on Korea's Kospi, which could have global ripple effects. Also, European stocks 50 futures down 0.7%. And as we brace for those Nvidia earnings later, Nasdaq futures flat to the downside too. S&P E-minis are also down 8 basis points. Now, speaking of the risk events on the docket for today, at the top of the hour, we're going to get the latest UK April CPI numbers. That hot on the heels of those weaker than expected jobs numbers yesterday. So is this going to lead traders to trim bets on BOE hikes even more? 57 basis points of tightening currently priced. Then at 7 p.m. London time, we'll get the latest Fed minutes. This is from Jay Powell's last meeting as chair, expected to be hawkish and reinforcing the message that officials are not ready to cut rates. Then at 9:20 p.m. London time, perhaps the highlight of the week, Nvidia earnings. These expected to either ease or reinforce concerns about an AI bubble as the chipmaker marches towards a $6 trillion valuation. Let's set you up for the day ahead. We begin with stocks in Asia falling for a fourth day with Korea's Kospi whipsawing on the news that Samsung workers plan to go on strike. Let's get an update now from Anthony Stevens in Hong Kong. Anthony, what's happening where you are?
Hey. It's been a choppy day, right? We've had the Nikkei trade in a 2% range. It's down for the fifth consecutive day. That's the longest losing streak since Jan. The Kospi is traded almost in a 6% range, low to high, and that's a lot to do with Samsung, but it's been choppy all this time. We are getting a little bit of pressure from these bond yields. Bond yields aren't doing very much today, but it's just the absolute level these yields are trading at and the absolute level of Brent oil as well at 110 as this conflict drags on. So the bar to kind of positive surprise has come up very high. At the moment, we're looking at Nvidia. There's a rational risk taking in front of that earnings. People are taking down some risk, just like you saw in the US, and that's driving some rotation as well. You see Chinese equities are actually kind of resilient. The Chinese chip ecosystem in particular is doing quite well as Alibaba releases some new chips. So you're seeing this rotation within tech, but net it works out to another down day in Asia as we await Nvidia and the Fed minutes.
Anthony, thanks for the update. That's Anthony Stevens out of Hong Kong. Well, talks between Samsung and its largest union have broken down, with the union saying that a strike is now planned for tomorrow. The two sides have not been able to come to an agreement in this dispute over bonus payments, and a strike could now risk production delays. Let's bring in Bloomberg's Yumlin Lee for an update. So, Yumlin, what's the state of the talks between Samsung and the union as things stand?
Sure. So the union said it's going to go ahead with a planned strike tomorrow because the management rejected the proposal mediated by the government in the last 3 days. So one of the sticking points of the talks have been over the performance bonuses. Samsung has come out and said the negotiations has failed because the union's excessive demands, even though the company has accepted with the majority of what they were asking for, some of the areas where they were asking was just too much to accept. For example, they said the union demanded sort of performance bonuses over on operating units that are loss making, and they said they directly goes against their principle, and that would set very dangerous precedent for the company, not only the company, but for the entire country. So, but both sides have left some doors open. So, last minute agreement is potential, but I think the, government mediated talks are just collapsed. So as of now.
OK, so let's say the strike goes ahead. Just walk us through the scale of the global disruption this could cause.
Sure. A lot of analysts that I've spoken with, they're not really expecting full shutdown of any sort. There have been already measures in place. For example, Samsung has asked for injunction on very illegal workers' movement that would restrict the production. For example, earlier this week, the court has said you need to have a certain number of workers maintaining the production lines and safety measures, and the workers are not allowed to occupy the operation facilities. So this really was the biggest problem and the risk that Samsung was facing. So now the workers have legal restrictions that they are not allowed to do illegal, activities as such, so that, the operations are maintained. Also, there's another way to restrict the, kind of worst case scenario. Basically, the government has come out and hinted that they could lean on this very rarely used labor law that would essentially stop the government to intervene and stop the strike for 30 days. It's very rarely used, 4 times so far in the Korean history, and last time it was used was 2002. So but they have already hinted that they will go ahead. So this is another possibility that we can expect.
OK, Yulim, thanks for staying across it for us. Bloomberg's Yulim Lee in Seoul. Thank you. Well, turning to broader markets now, bond yields holding at elevated levels, piling pressure on global equities, with the 30-year Treasury yield touching its highest level since the eve of the global financial crisis back in 2007. Let's bring in Ben Ram now, our cross-asset strategist over at Bloomberg MLive. Ben, we've got strategists at Barclays and Citi saying that yields could reach 5.5%. Just walk us through the risks for global investors.
And I think that, if yields go anywhere near as high, I think that equities will start shuddering. So far, they have been overlooking all the risks coming from inflation and from the surging bond yields. If you look at the equity risk premium built into the S&P, it's negative because the S&P's earnings yield is less than the Treasury yield and the long-dated yields, definitely. So therefore, I think that the markets have been complacent for too long. The equity markets have been complacent for too long. Valuations, particularly on the S&P 500, as opposed to the Nasdaq 100, are kind of frothy, and I think they are unsustainable. So I think that fair value on the S&P is more like 5,700. And therefore, I think that the equity markets will begin to shudder the longer these yields stay on the boil.
OK, and we also heard from the Philadelphia Fed President Anna Paulson weighing in on the policy outlook overnight. Ben, let's just take a listen to that.
Policy is mildly restrictive, and that restrictiveness is helping to keep inflation pressures in check while the labor market remains stable. Keeping rates steady allows us to assess how the economy is evolving and the risks to both price stability and the labor market.
So we'll get more insight from the Fed minutes later today, but how could the latest bond moves complicate the path ahead for the Fed?
Well, the bond markets are suggesting that it would be a terrible policy mistake for the Fed to be even entertaining the idea of a rate cut at this point. As Paulson was saying, I mean, she's saying that the rate is mildly restrictive, but if you run the Taylor rule rate, Lizzie, what you see is that the rate is just neutral, not restrictive at all in any sense of the word. And given the inflationary pressures that we have got from the war, I think that there is a need to take policy into restrictive territory, considering that especially that the US economy has been pretty resilient through all this. So I think that in the coming months and in the coming weeks, the markets will realize that the natural way for the natural direction is higher for the Fed funds rate, not lower, and that will put pressure on the two-year yields. I've been saying for a long time that, the two-year yield, as the two-year maturity has been glossing over this reality, and now we have seen the sell-off, and I think it's got further to go, really.
You have indeed. Ben, thank you for your insights again. That's Ben Ram, cross-asset strategist at Bloomberg MLive. Well, going back to the geopolitics now, Russian President Vladimir Putin's meeting Chinese leader Xi Jinping in Beijing to strengthen their alliance just days after US President Donald Trump's visit to Beijing. Now, state news agency Xinhua reports that Xi told Putin a ceasefire in the Middle East is imperative. Let's go now to Bloomberg's chief Asia correspondent, Rosalind Matheson. Ros, just bring us the latest from this summit.
Well, you've seen a lot of fanfare so far today, a lot of pomp, really on a par to a more recent visitor, of course, US President Donald Trump to China. So sending a clear message there that both China and Russia see this relationship as important and useful, even if China probably doesn't see it as equal. They see themselves as the more senior partner in this equation. So certainly a lot of pomp there. You see the Russian president quoting Chinese proverbs, calling Xi Jinping his dear friend, saying Russia can be a reliable partner, particularly when it comes to energy, which is the crucial thing in this relationship. Interestingly, you have Xi Jinping making a couple of other comments so far. One was he said that Russia and China need to work together towards a more just and reasonable global order, which is a bit of a ding at Donald Trump in the US potentially. And also saying very clearly he thinks that the war in the Middle East needs to come to an end ASAP. So a message also to the US in that potentially to hurry up and wrap up that conflict. Of course, Russia may disagree because for them the conflict in the Middle East is potentially useful given it's bumping up energy prices and making their energy in higher demand. But certainly we've seen lots of warm words so far, lots of warm symbols, very much sending a message that this relationship is important.
So beyond the symbolism, Ros, what else is on the agenda?
Well, obviously a lot of conversation behind the scenes about this planned pipeline from Russia, this gas pipeline from Russia to China, because Russia is wanting to speed China up and the commitments about it, and certainly maybe behind the scenes get more of a commitment around the contract price for gas to maybe a better price than might be on the table already. And China's been moving fairly slowly on that, so they want to really speed that up. So that's one tangible that may come from this. But also some of the conversation is going to move much more behind the scenes as we go on. The Russians making much of this idea of the two leaders taking tea together and having a much more private conversation. So then we're going to get the really meaty stuff happening, potentially around the pipeline. But also, does Vladimir Putin try and get a better sense of Xi Jinping about his recent meeting with Donald Trump, for example? Does the Chinese president use that moment to press him a bit in turn on his war in Ukraine? So that's where we're going to see some of those deeper conversations happening. And that's certainly where Russia is hoping to get some kind of agreement potentially on this pipeline.
OK, Bloomberg's chief Asia correspondent Rosalind Matheson, thank you for the update. The state broadcaster CCTV saying that a document signing ceremony is going to take place soon between the two nations' officials. So do keep an eye on that. We've got a fantastic T-Live blog running at the moment with all of the latest developments. But still ahead here on Daybreak Europe, UK inflation data might give Prime Minister Keir Starmer a much-needed boost, but could it be short-lived? We'll dive into the details. First, though, President Trump warns there's limited time for a peace deal, and we'll get you the latest from the region next. This is Bloomberg. Well, Welcome back to Bloomberg Daybreak Europe. Just coming up to 6:17 a.m. here in London. And we turn now to the Middle East. President Trump threatening to resume strikes on Iran in the coming days as part of a push for a deal to end the war. The latest threat came after Trump said that he'd called off a planned attack after an appeal by Gulf allies. And this comes as NATO is discussing the possibility of helping ships pass through the blocked Strait of Hormuz if the waterway isn't reopened by early July.
I had made the decision. So they called up, they had heard I made the decision. They said, sir, could you give us a couple of more days because we think they're being reasonable.
How many days for Iran to come to?
Well, I mean, I'm saying 2 or 3 days, maybe Friday, Saturday, Sunday, something, maybe early next week, a limited period of time.
Let's get analysis now with Jumana Basechi, Bloomberg's Horizons Middle East and Africa anchor, who joins me in studio. So, Jumana, how seriously should markets be taking Trump's threats there on Iran when you've got the Republican-led Senate signalling opposition to continuing the war?
Yeah, well, look, we've been here before. Trump has made threats to Iran many times in the past throughout the course of this, well, it's almost been going on for 3 months now, the Iran war. This time he's saying that at the request of Gulf allies, and we spoke about this yesterday, they held off of an attack. They were ready. He says we were ready to go within a matter of hours, days. And then he was asked by reporters if they do go down the military track, when could it happen, or how much time does Iran have to come to the negotiating table? He said a matter of days. So again, it's not completely out of the picture, but what he is suggesting is that there could be room for a breakthrough in the coming 48 hours or so. And that was echoed by the Vice President J.D. Vance, too, who struck a more constructive tone. And he said that Plan B is military action. Plan A, for the time being, is to continue with those negotiations with the hope that we get either a resolution or, at least as I spoke about yesterday, a framework towards a resolution. Now, at the same time, what's becoming apparent is neither the Gulf allies have a huge desire to go back to intense kinetic military action, as we saw before the ceasefire, and even President Trump back home. There's a lot of public backlash from the public, rising gasoline prices, and as you mentioned, the Senate yesterday passed a procedural vote that indicated that really the tide is turning even within the Republican Party insofar as this war is concerned, that the support is waning.
And you just wonder, therefore, whether there's enough pressure on Iran to make a deal that includes the nuclear file, which, as you keep telling us, is what the US wants. Now, I mentioned that NATO is considering this Hormuz mission to protect ships. How big of a strategy shift would that represent if they can get the necessary unanimous support, which they don't have yet?
No, they don't have unanimous support. And remember, NATO has been subject to a lot of criticism by President Trump for not being actively involved in this conflict. And remember, NATO is a defensive alliance. They're not going to get involved voluntarily in a war that they didn't start. But again, President Trump has been appealing to them, not formally, but through his True Social posts. And our latest reporting, having spoken to various sources within NATO, suggests that they are perhaps thinking about a mechanism to help get vessels through the strait if the strait continues to be effectively shut in July. Now, it doesn't have unanimous support yet. There's a motion that's building. There's discussions that are taking place. And remember, there's also a separate motion being put forward by the UK and by France. They're trying to build a coalition of nations, not necessarily just NATO allies, but also European, Asian, even Gulf allies as well, to help transport and escort even some of those ships through the strait. But it does mark a different strategy to NATO. And I think, Lizzie, it also underscores that nobody had expected 3 months on for the strait to still be effectively shut, and people's patience are running thin. There has to be a solution, and if it's not military, then there needs to be some other form of a diplomatic solution in order to help get some of these stranded vessels, and there are thought to be about 800 of them, 20,000 seafarers still trapped in the Persian Gulf.
And perhaps that diplomacy could help bring down the oil price and remove some of Iran's leverage. Jumana, great to have you with us, as ever. Bloomberg's Jumana Basechi. Well, coming up, the Pentagon pushes ahead with plans to pull US troops out of Europe. We'll get to that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some of the top stories we're following for you around the world this morning. The US Defense Department says that it will permanently cut around 4,000 soldiers from Europe as part of a broader review of forces. A Pentagon spokesman says that the move is meant to push NATO allies to take primary responsibility for Europe's conventional defence. The cut will bring the number of US Army Brigade combat teams stationed in Europe from 4 to 3. Meanwhile, Republican congressman and vocal Trump critic Thomas Massie has conceded defeat in his primary election to a candidate backed by the president. Massie used his concession speech to hit out at President Trump for focusing on the construction of a White House ballroom while prices remain high. This after an election race which has seen nearly $33 million spent, making it one of the most expensive primaries on record. And the Republican-led US Senate is showing growing opposition to the Iran war. 4 Republican senators joined Democrats in a procedural vote backing a measure to halt hostilities, the move signalling weakening support for further military action as President Trump weighs another strike on Iran. Now to one of our top interviews. The Bundesbank president, Joachim Nagel, says that the ECB may have to respond to the economic challenges arising from the conflict in the Middle East. He spoke to us alongside French Central Bank Chief François Villeroy de Gallo on the sidelines of the G7 meeting in Paris.
This whole conflict started more or less 3 months ago. Now we know that this energy supply shock is more persistent. So we are moving away from our baseline scenario.
We are in difficult circumstances. You mentioned them, but the discussion was lucid without any complacency. It was a free discussion at the highest possible level, and it was a confident discussion. And we shared the analysis on global economies. We shared the will to reduce global imbalances, to address the negative consequences of the conflict in the Middle East. And for us central bankers, we are fully determined to bring inflation back to target.
And our central bank conversations continue today. Pierre Wunsch, the governor of the Bank of Belgium, National Bank of Belgium, joins Francine Lacroix on the pulse for an exclusive conversation at 9:15 a.m. London time. Now, let's go to our corporate news this morning. Bloomberg learning that Goldman Sachs and Morgan Stanley have secured the lead positions for SpaceX's upcoming initial public offering. Billionaire Elon Musk's rocket, satellite and artificial intelligence firm is targeting a $2 trillion valuation. The listing expected to raise up to $75 billion, potentially making it the biggest IPO in history. Elsewhere in tech, Meta has begun notifying thousands of staff that they're being laid off, with the first alert sent out in Singapore at 4 a.m. local time. An internal memo says that affected European and US-based employees will also be notified early Wednesday in their own time zones. Meta is cutting around 8,000 positions globally in a restructuring aimed at improving efficiency and cutting costs. And Google has announced a redesign of its search box and plans to add new AI coding tools as the company looks to expand its AI offering. The company says that its changes to search will allow it to better handle the more complicated requests that people bring to chatbots. Well, that's some of our top corporate news this morning. Coming up, the EU finally agrees the wording of a trade deal with the US as it bows to President Trump's deadline demands. We'll get you the details next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Global stocks head for their longest losing streak in more than 2 months as inflation fears grip investors. The bond sell-off sending long-end Treasury yields to their highest since 2007. Traders now await earnings from Nvidia. The Chinese president says a ceasefire in the Middle East is imperative as he welcomes Vladimir Putin to Beijing just days after his summit with President Trump. Plus, backing down, the EU finally agrees on the wording of a trade deal with the US, taking out amendments that were criticised by Donald Trump. Well, a very good morning. Welcome to the programme if you're just joining us. 6:30 a.m. here in London. And this is the picture in markets this morning. Just take a look at the impact of President Trump's threat to resume those Iran strikes in a push to end the war, as we were discussing with Jemana Basecci. So oil a touch weaker, but Brent still trading above that $110 a barrel level on Brent. So that's stoking inflation concerns. The 30-year Treasury yield at levels last seen in 2007 on the bets that the Fed will have to hike before it can cut. And we're now at 5.17, but Citi saying look at 5.5%. That's the new round number that bond traders are focused on. Now, you've got the Bloomberg Dollar Spot Index flat to the upside, but of course this has been the haven of choice through the Middle East conflict. So it's at its highest in 6 weeks at this point. And if we turn over to the equity picture, you can see how all of that inflation angst is weighing on stocks as well. Asian stocks down 1.1%, down for a fourth straight day on the MSCI Asia Pacific Index, and Samsung shares dropping after its labour union said it would go on strike. So that particularly weighing on the Kospi in Korea, that index down 1.7% and helping to drag Asian stocks lower. Now, do we see a global effect of that? You've also got European futures lower 0.6%, and as we brace for Nvidia earnings later, US futures down a touch. For S&P E-minis, we're actually flat to the upside when it comes to Nasdaq futures. Now, time for our front page news this morning. Kicking off with the Financial Times, they say that EU governments are discussing whether the former German Chancellor Angela Merkel or former ECB President Mario Draghi could represent the bloc in potential negotiations with Vladimir Putin. This as momentum gathers to reopen formal channels with Russia. If we flip over to the Wall Street Journal this morning, they're leading on Thomas Massie's defeat in the congressional primary in Kentucky. The paper saying that the success of President Trump's hand-picked candidate underscores his iron grip on the Republican Party. And finally, if we turn over to Les Echos out of France, their headline reads, US debt has entered the danger zone as interest rates return to crisis levels. And we'll turn back to that later on in the programme. But for now, you can get a roundup of the stories you need to know to get your day going, as ever, in today's edition of Daybreak, which terminal subscribers can find by going to DAYB Go. Now, after months of negotiations, the European Union finally has agreed the text of its long-awaited trade deal with the United States. Under the agreement, the EU will remove levies on US industrial goods in return for a 15% ceiling on tariffs. Oliver Crook's been across all of this for us, our chief Europe correspondent, of course. Ollie, just how much is this going to calm transatlantic trade tensions?
Well, they really should take some of the heat out for the moment in the short term, because, of course, this is a great objection of the Trump administration. This was a handshake deal between Ursula von der Leyen and Donald Trump about a year ago, back in Turnberry in July, and it has still not been fully put into effect by the Europeans. But as of 2:30 this morning, we saw the red headline cross as we understood that the negotiations had been concluded here on the side of the lawmakers and the member states of the final text of that deal, and can now move forward to try to meet that deadline that the President of the United States set, July the 4th, 250th birthday of the United States. They need to get it in there in place. Otherwise, the Trump administration will administer some additional tariffs, namely on the auto sector, to the tune of 25%. And we should just remind everybody, Lizzie, this is the same deal we've been talking about for the last year. This is the deal that would govern the $1 trillion trading relationship between the EU and the United States. There is, however, Lizzie, a little bit of fine print that was added into this deal, which I'll just go through very quickly. The trade deal will expire in 2029. The initial draft back in March had this expiring in March of 2028, which was before the Trump administration would actually end. So that changed. That is something that's sort of interesting. Also, it will suspend the deal can be suspended for a number of different reasons, particularly if they do not get a deal on steel and aluminum tariffs that are currently at 50%. The EU wants that to come down to the 15% of everything else by the end of this year. And of course, Lizzie, they say that if there are any violation to the commitments, the EU can suspend this deal. That would mean, presumably, additional threats of tariffs, as we saw Trump do when he wanted to take Greenland. So now the next steps, Lizzie, this will go to the European Parliament. It will go to the member states for the final ratification. But the big question, Lizzie, is will the U.S. have objections to some of these little things that the EU has added to this deal? We heard from Jameson Greer a couple of weeks ago saying that this is not the deal that the U.S. had signed up to. So we'll await. We'll probably hear about it on Truth Social at some point in the coming weeks.
OK, Ollie, thank you for the update. That's Bloomberg's Oliver Crook, Chief Europe Correspondent. Well, we're looking ahead to another key data print out of the UK today. Inflation figures due at the top of the hour. These are for April, due at 7 a.m. London time. And economists are forecasting CPI at 3% on the year. So that's an ease from the 3.3% print that we saw for March. Let's get analysis now with Matt Bunny from Bloomberg Economics. So, Matt, what should investors be looking out for in these numbers? And even if we do get a softer print, what are you expecting in terms of the future? How much worse could it get? How long could it last?
So we've penciled in a decline to 3.1% today. That might be surprising given all the discussion about the energy shock and how that's going to push up inflation. In April, effectively, we're expecting that previously announced government policies, this is from budgets in previous years, will soften the print. That is going to be offset by fuel prices. Anyone who has a car will know filling up at the petrol pump has increased dramatically in the past couple of months. The other thing we'll be looking at is if there are any signs that in the wider CPI basket, we're seeing inflation begin to heat up in relation to the energy shock. So we're expecting food and beverage inflation to pick up a little. Looking ahead, we think that inflation will peak around 3.5% early next year. Of course, this all depends on the path of the conflict in the Middle East. If it gets worse and energy prices get higher, we think inflation could even reach as high as 5%.
And we've talked a lot about gilt yields in the context of the political uncertainty at multi-decade highs. It's not just a US story, of course. Do you think that the bond market's pricing in more persistent inflation than the BOE is acknowledging?
So the bond market has priced in 3 hikes over the next year. We have penciled in 1 at this stage. I think with inflation set to head higher and the Strait of Hormuz not looking like it's reopening anytime soon, the BOE will be minded to hike in the coming months. The important distinction to make is the weakness in the labour market, which means that workers are not well placed to extract higher pay rises as they were in 2022. So our base case is that this will be a one and done move. And the BOE has been at pains to underscore that the uncertainty at the current juncture. So if we do see a re-escalation in this conflict, particularly if we see signs of second-round effects, that would necessitate a more forceful response.
And indeed, yesterday's jobs numbers brought market pricing a little more into line with your view. Right, Matt Bunny, thank you very much. We'll wait for those numbers at 7 a.m, but that's Matt Bunny from Bloomberg Economics. Now, EU defence spending, up more than 50% since Russia's invasion of Ukraine, is now starting to drive demand in the real estate sector. Bloomberg's Natasha Vos has that story and joins me now on set. So, Natasha, thanks for coming on the early show. How is the real estate market starting to see the impact of the EU's defence spending splurge? How are we seeing it show up in the numbers?
Yeah, so it's been pretty slow to come through since governments started to increase their spending. But we are now starting to see an increase in the proportion of leases taken by defence companies and their supply chain. So we got data from CoStar and Savills, which showed that the proportion of leases taken by those companies had more than tripled since a decade ago. And it's starting to come through in different areas. So there are some hubs emerging. Swindon, for example, in the west of England, is starting to emerge as a bit of a drone hub.
OK, and what kinds of real estate are getting the most demand?
Yeah, so for the moment, it's mostly industrials and logistics. That's warehouse space, manufacturing space, but also offices a little bit. As companies expand, they hire more people. They need more people in research, for example.
And do you think that investors are getting more comfortable investing in defence-related real estate?
Yes, this is a bit of an interesting one because about a decade ago, there wasn't that much demand from defence-related companies to take more real estate. Whereas now there is. So it's a little bit chicken and egg trying to work out whether they are more comfortable or it's just that there are more companies looking for space. But there certainly is a sense that they're more vocal about the positives of taking defence-related companies. One of the positives can be that the leases are sort of part government-backed because the money is coming from a government.
So what holds this back? Are there limitations on the impact rising defence spending could have on real estate?
Yeah, so it's probably not going to be quite as big as, say, the e-commerce boom in terms of the impact on real estate.
Yeah.
But one of the limitations is that a lot of defence companies, they do prefer to own and occupy their own space, or they might be in government-owned space. So the real estate companies are looking more to take parts of the supply chain, which are perhaps easier, particularly with security requirements, which can differ from country to country, and it depends also on what you're doing there. But those can also be a limitation.
Makes sense. Natasha, thanks for bringing that story to us. That's Bloomberg's Natasha Vose. Well, coming up on Daybreak Europe, it is, of course, Nvidia Day, and we're going to preview the numbers for you. What to watch when the world's most valuable company reports after the bell. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:43 a.m. in London. And this evening, UK time, Nvidia will be giving us a much-anticipated update on the state of the AI economy when it reports its first quarter results later on. For more on what to expect, let's get the latest from our Bloomberg senior strategist, Neil Campling. So, Neil, this is like a macro event at this point. What should we be focused on in these numbers?
I think, Lizzie, the question now, with this company being so large, is not so much the short-term outlook. Analysts and investors have come to expect good numbers coming out from Nvidia. It's more about the long-term guidance. Now, taking a step back, one thing we will expect tonight is an 80% growth rate for revenues year on year. I mean, quite astonishing numbers given it's such a large company. But it's more really about the long-term outlook for the ecosystem in terms of what they're doing on the technology side, and also I think in terms of how they're sort of pitching in terms of the long-term growth opportunities for the industry. But we're clearly looking for a very high growth number, and we're also expecting that to feed into the ecosystem and getting a sense of where the demands are coming from, and maybe an update on China as well, because of course at the moment we've got no revenues expected in these Chinese AI chips, which could be incremental upside to where people are expecting it.
And of course, Nvidia is really at the heart of this web of CapEx that feeds through all of tech. So how important are these results for the rest of the tech sector? I know you've been calculating the compared size of Nvidia to our own stock exchanges.
I know, a bit depressing in some ways, but Nvidia obviously is in some respects kind of like a global economy in itself. It's a $5.3 trillion company. To put that in context, the FTSE 100 is $3.5 trillion.
Wow.
The DAX is $2.3 trillion. So Nvidia is twice the size more than the DAX. But it feeds into the European AI ecosystem in terms of the power consumption, data center build-out, etc., as it does for the $700 billion plus capex spend from the hyperscalers expected this year. So it's crucial that the growth is maintained and we get good updates. And also, some of the new chips we've been talking about should require less memory chips, which actually, given the concerns we have over Samsung and the output of memory, that could actually be an incremental benefit to the entire complex that will require perhaps less memory going forward with these self-serving chips in the data centers.
OK, so we could see some massive market gyrations in the morning. We'll have to get you back after these results. Neil Campling, our Bloomberg senior strategist, thank you very much. And you can get up-to-date analysis on all things AI with Bloomberg's AI Today newsletter. Every day it breaks down AI's threats as well as the opportunities for business, finance and more. Do sign up at bloomberg.com/newsletters. Well, the energy crisis spiked by the war in Iran has provided a stark backdrop for BloombergNEF's 2026 edition of the New Energy Outlook. It's long-term energy and climate scenarios for a low-carbon transition. So what do the next few years hold for renewable power, EVs and next-generation technologies? We can find out now with David Hostert, BNEF's chief economist and lead author of that report. He joins me now on set. Good morning to you. I want to start with the key energy transition technologies. You've got solar power, wind turbines and EVs. How does their uptake differ around the world?
Yeah, good morning. So this has been another report, another kind of at the backdrop of a big crisis that we're sliding into. And what's been really interesting is that the outlook for key technologies that we're tracking for EVs, for batteries, for renewables is very strong. And indeed, we have upped our uptake for some of these markets. This is against a kind of very stark backdrop. We have also increased our nuclear uptake slightly. And this actually links into something that Neil said just earlier about the growth in data centers, because that's also something we're tracking.
OK, so the biggest challenges then facing the transition that you're identifying, we've talked about the geopolitics, what else is there?
The big challenge is, on the one hand, trying to meet that growth So we're now again in an era with strong growth in electricity. We're seeing data centers as a major driver. We're seeing electric vehicles as a major driver, but also other things, cooling. So electricity as a fuel, as a final fuel, has been rising, and it started to overtake other fuels. And solar plays a huge role in this. So we're seeing by 2032, solar could be the largest generator of electricity worldwide, overtaking coal, overtaking gas. So that's a big kind of hinge moment that we're moving towards.
We know that energy security is dominating policy agendas around the world. What gives you confidence in your projections?
The current report that we published doesn't assume kind of a big oil spike yet, but what we modeled this is at $80 oil. But when you see what's going on and compare how the share of imports in GDP for energy imports changes over the outlook, you can see that actually the countries that have the most to gain from switching to renewables, from electrifying, are the countries that are the most affected by the current crisis. Think about Vietnam, India, countries in Asia. So these are the countries that actually can reduce their exposure the most and liberate themselves from kind of dependence on energy imports.
So let's say geopolitics gives that push and they follow through on it, those nations. When do we see the peak of fossil fuel use?
Our projections see fossil fuel peaking, for oil peaking in the late 2020s. It's a very flat peak, so it could be a little bit before, it could be a little bit after, but definitely what we're seeing is that oil is in structural decline, coal is in structural decline, but the swing fuel is gas. So gas demand is actually up, in part boosted by power demand in the US, again coming back to data centers where gas is just still a cheap fuel. And we see gas demand rising throughout the outlook, but for oil and coal there's this decoupling, and indeed a decoupling between oil and gas, which have historically moved in tandem.
Okay, really interesting. That report is available to read, and David Hoster, Chief Economist at BloombergNEF, lead author of the new Energy Outlook. Thank you very much. You can check out all of those charts in the report. Now to some other stories this morning. Live Golf is said to have started laying the groundwork for a potential US bankruptcy filing if it fails to raise new funds. Sources say that the league's currently looking for money after its main backer, the Saudi Public Investment Fund, pulled its funding. We're told Live Golf is preparing for its potential collapse when the season ends in late August. And staying with sport, Arsenal Football Club has won the English Premier League title for the first time in 22 years. Thousands of fans celebrated in the streets of North London as Manchester City's challenge ended with a draw in their game at Bournemouth. Arsenal had finished runners-up in the past 3 seasons. They now face PSG in the final of the European Champions League on May 30th for a chance to secure a rare double. Well, let's check in on these markets, shall we? Of course, we're factoring in the latest from the Middle East. President Trump saying that he could have new Iran strikes to try to end the war. That keeping Brent above that $110 a barrel level, even if it's down 0.4%. That stoking the inflation concerns. And just to pick out the 30-year Treasury yield, we're at 5.18 now. We've seen it at levels not seen since 2007, on the bets that the Fed's going to have to hike before it can cut. And as the war goes on, the haven of choice, of course, being the dollar, the Bloomberg Dollar Spot Index, holding on to its gains. It's at its highest in 6 weeks, just flat to the upside there. A brief scan of the equity picture this morning. As we have the inflation angst, it's weighing on stocks in Asia, down 1.1%, not helped by the threat that Samsung's biggest labour union would go on strike. But futures on both sides of the Atlantic in the red as well, down 0.7% for Euro Stoxx 50 futures and down 0.1% for S&P evening as we brace for those Nvidia earnings out later on today. Nasdaq futures ever so slightly in the green. Well, we've got plenty more coming up for you. We shall remind you of the risk events on the docket for today, and we'll set you up with some terminal charts. Stay with us. This is Bloomberg.
every policymaker, macro forecaster, central banker, tech promoter is telling you right now there is no problem. Every commodity CEO, commodity trader, anybody who gets their hands dirty is telling you you have a problem.
Veteran strategist Jeff Curry, now co-chair of ABAX Markets, on those oil shortages. And let's take a look at the impact on long-end borrowing costs. You can see here yields have been up around the world. These showing the US, Japan and German and UK bonds here. But it's not just because of hardening inflation expectations, both from oil and AI capex. It's also about the idea that central banks might do nothing about it, particularly when you've got fiscally loose governments already in the US and Japan, potentially also in the UK. That thesis going to take some stopping. So let's take a look at the short end of the curve and the nightmare for incoming Fed Chair Kevin Warsh. You've got him caught between a job market that supports not cutting and the risk that he is bullied by this bond market. Do we see the Fed therefore on an extended hold? Well, then you might ask, what is the impact on the mortgage market? One more term chart to show you this morning. If you take a look at where US mortgage rates are, actually pretty resilient. And therefore, even if you've got yields back at 2007 levels on 30-year treasuries, maybe it isn't time to compare the stress to the GFC time quite yet. To access, search and save all of these terminal charts used on the show and across Bloomberg TV across the hours. As ever, terminal subscribers can use the function CHRT TV Go. A reminder of the risk events on the agenda for today. In just a few minutes' time, we'll get the latest UK inflation data. At 7 p.m. London time, it's the latest Fed minutes. Of course, the last meeting with Jay Powell. How hawkish do they sound? And then 9:20 p.m. London time, the highlight of the week, perhaps, the Nvidia earnings. Is this going to ease or reinforce concerns about the AI bubble? So all of that coming up throughout the day. But up next, the Euronext CEO, Stefan Bujna, joining us to talk earnings at 7:15 a.m. London time. That on the opening trade. Anna, Guy and Tom will take you all the way to the market open. Good morning from London. This is Bloomberg.